To build wealth, it's important to understand the difference between assets and liabilities. Assets are things that put money in your pocket. These could be investments, businesses, or anything that generates income for you over time. The more assets you have, the more money you make, and the richer you become. On the other hand, liabilities are things that take money out of your pocket. These could include debts, loans, or anything that requires you to spend money without bringing in income. The key to becoming wealthy is to focus on accumulating assets that generate income. The more you have working for you, the more financial freedom and wealth you'll build. Now let's look at 20 types of assets that the rich often use to grow their wealth even faster. Number 1. Mutual and index funds. Stocks allow you to invest in individual companies, but mutual and index funds give you the opportunity to invest in a group of companies all at once. By investing in these funds, you're purchasing shares of a whole basket of companies, which makes your investment more diversified. This is generally safer than buying individual stocks because your risk is spread out across multiple companies. Instead of relying on the performance of one company, you're investing in many, which increases your chances of success. Statistically, index funds have been one of the best performing investment options over time. Some of the most popular index funds include the Fidelity Zero Large Cap Index, Vanguard S&P 500 ETF, SPDR S&P 500 ETF Trust, iShares Core S&P 500 ETF, and Schwab S&P 500 Index Fund. The main advantage of index funds is that they make investing simpler and less risky. If you were to buy individual stocks, you're statistically more likely to make mistakes or struggle to beat the market. Investing in individual stocks requires a lot of research and effort, and even professional traders often struggle to outperform the market over time. With an index fund like the S&P 500, you're investing in the 500 best-performing companies, and when a company falls out of the top 500, it's replaced with a better-performing one. Over the past 90 years, the S&P 500 has delivered an average annual return of around 9.8%. Of the various index funds available, Vanguard is often seen as the top choice due to its strong performance and low fees. If you're looking to build wealth over the long term, index funds should be a key part of your investment strategy. Number 2, cash. Cash is a fundamental asset that plays a significant role in building and preserving wealth, even though traditional bank interest rates today are quite low and often don't keep up with inflation. While it's true that putting cash in a savings account may not generate substantial returns, keeping a portion of your wealth in liquid cash is still crucial for wealthy individuals. Take Apple, for instance. The company holds over $150 billion in cash reserves, giving them ample liquidity to respond to opportunities and manage risk. This flexibility is why cash continues to be a priority for the rich. There are 2 main reasons why wealthy people hold cash. First, having access to cash allows them to seize opportunities quickly. In the fast-paced world of business and investment, opportunities can disappear just as quickly as they appear. For example, a lucrative real estate deal, a private investment opportunity, or a chance to buy a business may require immediate action. If you don't have the cash available, you could miss out on that deal. This is why rich people prioritize saving cash. They know it gives them the ability to act fast when opportunities arise. Second, cash provides the chance to earn higher returns, especially through cash-based deals. When you offer cash upfront in a transaction, you may be able to negotiate better pricing or terms. Moreover, wealthy individuals often participate in peer-to-peer lending, where they lend money directly to individuals or businesses in exchange for interest payments. Unlike bank savings accounts, which offer minimal returns, often under 1%, peer-to-peer lending can provide much higher returns, ranging from 7% to 15%, or even more, depending on the risk and terms of the loan. Of course, higher returns usually come with higher risks, so it's essential to carefully evaluate any lending opportunities and be aware of the potential for loss. In addition to these 2 reasons, holding cash provides a sense of security and control. It allows the wealthy to avoid being overly reliant on credit or loans, which can carry high interest rates and lead to financial strain if not managed properly. Cash also gives individuals the ability to handle unexpected expenses or emergencies without scrambling to secure funding. By the way, if you're finding this video helpful and want more content like this, comment more below. Let's keep going. Number 3, real estate. Real estate is considered one of the best ways to build wealth, and many investors are drawn to it for two main reasons. First, rental income is a consistent source of cash flow. When you own rental properties, you can collect payments from tenants every month with minimal effort. By taking advantage of technology, such as renting out properties on platforms like Airbnb, you can earn even more through short-term rentals, though this requires more work than simply collecting rent on a monthly basis. Second, real estate appreciates over time. As the population grows, more people need places to live or rent, increasing the demand for properties. This demand drives up property values, making real estate a solid investment that can grow in value over the long term. When it comes to real estate assets, there are several types of properties you can invest in. Residential buildings are the most common, where tenants pay rent to live in your properties. Office buildings are spaces where businesses rent to operate, and commercial buildings are used by businesses to sell products or provide services, with rent paid for the use of the space. Additionally, land can be a valuable investment as it can appreciate over time, be developed, or used for various purposes. However, it's important to remember that the house you live in is not an asset. While it may provide you with a place to live, it doesn't generate any income for you. Instead, it's considered a liability because it costs you money in the form of mortgage payments, taxes, and maintenance without adding to your wealth. Unlike rental properties, which bring in money, your primary residence takes money out of your pocket. Number 4, bonds. When governments or companies need money, they can issue bonds, which are essentially IOUs sold to investors. When you buy a bond, you're lending money to the government or business, and in return, they agree to pay you a fixed amount of money, usually monthly or annually. Bonds come with an expiration date, which can range anywhere from a few months to 30 years. Bonds are considered safe investments because they're often backed by the government, making them a low-risk choice. However, low risk usually means lower returns. Most bonds offer around a 3% annual return, which is better than what you'd earn in a typical savings account, but may not be exciting for someone looking for bigger gains. When the bond's term ends, the government or business returns the initial amount you invested, called the principal. There are two main ways to buy bonds. You can purchase them directly from the government, usually through the Treasury Department, or you can buy them through a brokerage firm that handles these investments for you. Number 5, stocks. Stocks are simpler than many people realize, despite what movies about Wall Street might suggest. When you buy stocks, you're essentially buying a small ownership stake in a company. For instance, if a company has 10 million shares available and you purchase 1 million shares, you now own 10% of that company. This means you have a claim to a portion of the company's profits, and depending on how well the company does, the value of your shares can increase. What makes stocks such an attractive investment option is that they allow regular people to own a piece of some of the most successful companies in the world. This wasn't always the case. Only the wealthy used to have access to these types of investments. However, today, the barrier to entry is much lower. You don't need a lot of money to start investing in stocks, and with the right knowledge and strategy, anyone can get involved and potentially benefit from the growth of a company. The price of a single share can vary widely depending on the company's size, market performance, and other factors, but the ability to buy even just one share opens the door to potentially earning from the company's success. Number 6, trademarks. While patents protect your inventions, trademarks protect things like logos, brand names, or catchphrases. Trademarks are important because they help distinguish your brand from others. If you own a valuable trademark, you can make money by licensing it to others. This means that other businesses or individuals can use your trademark for a fee, creating a steady stream of income for you. A famous example of how valuable a trademark can be is Michael Buffer, the announcer known for his catchphrase, "Let's get ready to rumble." In 1992, he trademarked this phrase, and since then he has made over $400 million just from people paying him to use it in commercials, events, and other media. This shows how a catchy, recognizable trademark can turn into a significant financial asset. Trademarks can be protected locally or internationally, but enforcing them across different countries can be challenging. For example, 1 in 5 U.S. companies reports that companies in China are using their intellectual property without permission. This is one of the reasons why China has rapidly grown its economy. It often doesn't respect intellectual property rights. In fact, China is responsible for stealing over $600 billion in intellectual property from other countries each year, which highlights the value of protecting your trademarks globally. In short, trademarks can be incredibly profitable. By owning a valuable trademark and licensing it to others, you can earn significant income without having to produce or sell any physical products. Trademarks are an essential asset for any business looking to build long-term wealth. Number 7, brand and goodwill. Brand and goodwill are both key to a business's success, but they serve different purposes. A brand is the image or identity a company projects to the public. It's what the company wants people to think about when they hear its name, the values, style, and promises it makes. Goodwill, however, refers to the positive feelings and loyalty customers have towards the company. It's built over time through positive experiences, good service, and a company's reputation for treating customers well. Building goodwill is difficult and requires time and effort, but it's extremely valuable. In fact, customers can be so loyal to a brand that they'll go out of their way to support it. For instance, a company known for always providing top-notch customer service, like Zappos, can earn goodwill that makes people return even when there are cheaper alternatives available. This emotional connection is what drives repeat business and long-term success. Think about a local coffee shop that becomes a favorite place for people in the neighborhood. The coffee might not be the best in the city, but the welcoming staff, consistent quality, and positive experiences create goodwill that makes customers come back regularly. Over time, people start to feel attached to that brand, and they will recommend it to friends or continue supporting it when it expands to new locations. Similarly, imagine a smartphone brand like OnePlus. Although it doesn't have the same massive recognition as Apple or Samsung, it built a strong community of loyal fans who admire its commitment to quality and user-centered design. This goodwill has allowed it to grow, with people buying the phone not just for its features, but because they feel an emotional connection to the brand. These examples show that while a brand is the company's controlled image, goodwill comes from how people feel about the company and the positive experiences they have with it. And when a company successfully builds goodwill, it becomes a priceless asset. Number 8, people. People are often the most valuable asset in any business, even though it's easy to overlook until they're gone. Companies themselves aren't real entities. They're just names, ideas, and a collection of work put together by the people behind them. A company's success largely depends on the people who contribute their ideas, skills, and hard work. In fact, one person can completely change the course of a company with their creativity and vision. For example, when Apple replaced Steve Jobs with a former Pepsi CEO, the company nearly went bankrupt before eventually bouncing back and becoming one of the most beloved tech brands in the world. Looking at Apple again, Jony Ive, the company's lead product designer, played a huge role in creating the products that millions of people use today. The work of the right people within a company can make all the difference. In fact, there are cases where larger companies buy smaller startups just to bring their talented teams in-house. This practice is known as an acqui-hire, where the company buys out the startup for the talent it holds rather than the product itself. So when you hire the right people, those with innovative ideas and the drive to push the company forward, you're setting yourself up for success. The right team can turn your business into a thriving, profitable enterprise. Number 9, commodities. The prices of raw materials and commodities like oil, gold, and even things like luxury cars or art can fluctuate depending on market conditions. If you're smart about it, you can take advantage of these changes by buying when prices are low and selling when the demand is high. This principle is not limited to just physical goods, but can also apply to things like cryptocurrency, real estate, and currency exchanges. The key is to know when to buy and when to sell, which can significantly impact your financial success. For instance, the price of gold has risen by 221% over the past 15 years, This is a clear example of how certain commodities can increase in value over time, making them an attractive investment for those who are willing to hold on to them. Similarly, art has been outperforming the stock market, S&P 500, for the past 20 years. Many wealthy individuals understand that art is not just a form of creative expression, but also a solid asset that can increase in value. That's why high net worth individuals often spend large sums of money acquiring art. They see it as a way to grow their wealth while also enjoying it. Vintage cars are another asset that the rich are known to invest in. Unlike regular cars, which tend to lose value over time, rare vintage cars can appreciate in value, sometimes at an impressive rate. These cars are considered collectibles, and the demand for them continues to rise, making them a smart investment choice for the wealthy. Similarly, luxury watches have become a popular collectible, with some models appreciating in value as they become more rare and sought after. However, before you rush out to invest in something like a vintage Rolex or a rare painting, because you read somewhere that they can double in value, it's crucial to understand what you're investing in. It's easy to get caught up in the excitement of potential returns, but the most important rule of investing is to never put your money into something you don't fully understand. If you don't do your homework and learn the ins and outs of the market you're entering, you could easily end up making poor investment choices and losing money instead of making it. Remember, knowledge is power when it comes to investing. It's essential to educate yourself about the assets you're interested in before committing large sums of money. The wealthy don't just invest in things based on trends, they carefully research and assess the potential value of each asset before making a move. This thoughtful approach is what sets them apart and helps them build lasting wealth over time. By the way, if you're finding this video helpful and want more content like this, comment more below. Let's keep going. Number 10, books, songs, digital courses, information, or content. Selling information or digital products is an incredibly powerful way to make money because it's scalable. Once you create something, you can sell it over and over again without having to recreate it each time. For example, when you write a book, create a digital course, or produce a song, you only need to make it once, and it can generate income for you repeatedly. This ability to create something once and distribute it widely can greatly increase the value of your business and potentially make you very rich. Once your product is ready, your main job becomes promoting it and reaching as many people as possible. With things like music, the potential is even greater because if you create a hit, it could bring in money for years or even decades. Take the song Gangnam Style by Psy. He made over $10 million just from that one song, thanks to its distribution on platforms like YouTube and iTunes, plus revenue from merchandise, concerts, and licensing. Another great example is Mariah Carey's holiday classic, All I Want for Christmas Is You. This one song has earned her about $500,000 every year, and over time, it's brought in more than $60 million. What's incredible is that once these products are made, they continue to generate income with minimal ongoing effort, making them highly profitable long-term assets. Number 11, royalties. Royalties are payments you receive for allowing others to use your work or ideas, and they can be a huge source of income. For example, if you write a book and a movie studio wants to turn it into a TV show, you can get a share of the money the show makes. Think about a popular show like Friends. The cast and creators made a lot of money during the original 12 seasons, but it doesn't end there. The show's success allowed it to be syndicated, meaning multiple TV networks bought the rights to air reruns. Because of this, the main cast members still earn millions of dollars each year, just from reruns of the show. Royalties don't just apply to TV shows or books. They can come from anything that involves your intellectual property. For example, George Lucas, the creator of Star Wars, made billions through royalties. When he pitched Star Wars, the studios didn't think it would be successful. Instead of paying him a one-time fee, they allowed him to keep the rights to licensing and merchandising. Star Wars turned into one of the most successful franchises ever, and by 2011, the toys and merchandise alone made over $3 billion. Disney later bought Lucasfilm for $4 billion, but it only took them 6 years to make that money back, thanks to the continuing success of Star Wars merchandise and movies. Royalties can turn an initial investment into ongoing, long-term wealth, and this is why many successful creators build their fortunes through these types of deals. Number 12, franchises. Franchises are a powerful way to build wealth by investing in established business models with proven success. When you invest in a franchise, you're essentially buying the right to operate a business under a recognized brand with a set structure and support system. The advantage is that you don't need to build a business from scratch. You're buying into a system that already has customers, marketing strategies, and a track record of success. Franchise ownership can generate a consistent stream of income because the business is backed by a well-known brand and the business model has already been tested. Fast food chains, gyms, and retail stores are popular franchise options. While it requires an upfront investment, the potential for passive income, scalability, and an established customer base makes it a smart asset for those looking to build long-term wealth. Some of the wealthiest individuals started their businesses by buying into franchises, allowing them to scale quickly and reduce the risk associated with starting a business from the ground up. Number 13, collectibles. Collectibles, such as rare coins, vintage toys, comic books, or limited edition items, can appreciate in value over time. Wealthy individuals often invest in collectibles because, unlike regular possessions, their value tends to increase due to scarcity, historical significance, or high demand among collectors. For example, rare sports cards, luxury watches, and original works of art have long been proven to be valuable assets. Collecting items like rare wines, limited edition sneakers, or even rare books has become a popular way to build wealth. These items can be sold at auctions or through private sales for significant profit. The key to investing in collectibles is knowledge, understanding what will appreciate in value and what won't. While this can be an exciting and fun way to build wealth, it requires a deep understanding of the market and an eye for items with the potential for long-term growth in value. Number 14, angel investing. Angel investing involves providing financial backing to startups or early-stage companies in exchange for equity or debt. These investments can yield substantial returns if the startup succeeds. Wealthy individuals often participate in angel investing to diversify their portfolios and get in on the ground floor of emerging businesses. By investing in high-potential startups, they can earn a significant return if the company grows and succeeds. Unlike traditional investing, angel investing requires more risk tolerance since many startups fail. However, the potential upside is enormous, especially when investing in the right industry or sector. In addition, angel investors often have the opportunity to take an active role in guiding the company's growth and success. This asset class has created many successful entrepreneurs and investors, especially in technology and innovation-focused fields. Number 15, intellectual property, IP. Intellectual property, IP, refers to legal rights that are granted to individuals or businesses for their creations, inventions, and innovations. These creations can include trademarks, copyrights, patents, and trade secrets. IP is a valuable asset because it can generate income through licensing, sales, or royalties. Wealthy individuals often invest in IP because it has the potential to generate continuous income over a long period. For example, a songwriter or musician can earn royalties from their music, a tech company can patent a new product, or an inventor can license a new process to companies. The IP market has become one of the most lucrative fields for investors, particularly as technology and digital content continue to dominate the economy. Owning IP rights allows you to control how your creations are used and profit from them in multiple ways. Number 16, insurance policies. Wealthy individuals often use life insurance policies as financial tools to build wealth. Whole life insurance policies, in particular, offer a cash value component that grows over time. These policies not only provide a death benefit, but can also serve as an asset that appreciates in value. The cash value grows tax-deferred, and it can be borrowed against or used as collateral for other investments. The rich use these policies as a strategy to accumulate wealth, while also providing a financial safety net. By purchasing life insurance policies and allowing the cash value to grow, they can access funds for other investments or use them to diversify their wealth-building strategies. This asset class can provide financial security for future generations making it an essential part of many high-net-worth individuals' portfolios. Number 17, peer-to-peer lending. Peer-to-peer, P2P lending platforms allow individuals to lend money directly to borrowers without involving traditional banks. As an investor, you can earn interest on the money you lend, and the returns can be higher than traditional savings accounts or bonds. P2P lending provides a more flexible and potentially higher yield investment option for the wealthy, who can often afford to take on more risk for higher returns. Many P2P lending platforms specialize in different types of loans, such as personal loans, small business loans, or student loans. By participating in P2P lending, you can diversify your portfolio and generate passive income while potentially achieving higher returns. However, it's important to carefully evaluate the risks, as there's always the potential for borrowers to default on their loans. Number 18, high-quality businesses. Owning or investing in high-quality, established businesses can be a highly profitable asset. Whether it's owning a franchise, small business, or larger enterprise, businesses often generate steady income, provide tax benefits, and appreciate in value. Wealthy individuals often invest in businesses for long-term growth and to generate consistent cash flow. The key to making business ownership a successful asset is choosing the right type of business, one that aligns with your skills, interests, and market opportunities. Additionally, many wealthy individuals focus on buying businesses that are undervalued, with the intention of improving them and selling them at a profit. High-quality businesses can provide an investor with both passive income and long-term wealth-building opportunities. Number 19, unique rights. Sometimes certain groups or organizations have special advantages that give them a competitive edge, making these advantages valuable assets. For example, some businesses have exclusive rights or licenses that allow them to operate in specific markets where others can't. Take, for instance, companies that hold patents for a unique technology. This patent gives them the exclusive right to produce and sell that technology, preventing competitors from entering the same market unless they get permission. This legal protection becomes a powerful asset, allowing the patent holder to dominate the market. Another example could be a company that has exclusive distribution rights for a product in a certain region. Because they are the only ones allowed to sell that product in the area, they have a unique competitive advantage over other businesses that sell similar items. This exclusivity can make their business much more profitable. These kinds of special rights or licenses can give businesses an edge that others simply don't have, making them valuable assets in a competitive marketplace. Number 20, first mover advantage and proprietary business models. When you come up with a new idea that helps a business grow or change the way things are done, that idea can become an asset. A good example of this is the Apple App Store. It created an entirely new way for people to get apps on their phones, and it became a huge asset for Apple, changing the way we use mobile devices. Another example is how microtransactions in video games became a new way for companies to earn money, allowing gamers to buy small items or upgrades while they play. Netflix is another great example. They started by mailing DVDs to customers but then shifted to streaming, which changed the entire entertainment industry. This shift allowed them to grow rapidly and take advantage of the trend, while other companies were still stuck on DVDs. Now, streaming services like Netflix are everywhere. In the music industry, we've seen a similar change. People used to buy physical CDs, then digital music. Now, services like Spotify, Tidal, and YouTube Premium let people stream music on demand for a monthly fee. Airbnb also disrupted the hotel industry by offering a platform for people to rent out rooms or entire homes for short stays, making it easier and cheaper for travelers to find accommodations. If you can find ways to innovate or take advantage of any of these assets, you could create something valuable for yourself. Now think about which of these assets you'd want to pursue. Which one could help you build wealth in the future? We'd love to hear your thoughts in the comments.